Thinking about diving into investing, whether it's stocks, ETFs, high-yield cash accounts, or even cryptocurrencies, the opportunities are endless, but so are the risks. What if I told you there's a way to approach investing smarter, safer, and with greater confidence? In this video, we're breaking down essential insights to help you navigate today's complex investment landscape, from understanding high-yield cash accounts to the real risks of cryptocurrency and alternative assets. We've got you covered. Plus, stay tuned for some pro tips on maximizing your returns while minimizing risk. Welcome to The Money Philosopher, where we make the world of finance and investing accessible to everyone. Investing today is more versatile than ever, with countless options to grow your wealth. But here's the catch: every investment comes with risks, and understanding those risks is crucial. In this video, we'll explore the basics of brokerage services and how they work, the pros and cons of high-yield cash accounts, what you need to know before investing in ETFs and treasury bills, the truth about cryptocurrencies and alternative assets, how to interpret investment performance data to make informed decisions. By the end of this video, you'll not only understand these concepts but also feel equipped to make smarter financial choices. Let's dive in. 1. The basics of brokerage services. First up, let's talk about brokerage services. If you've ever bought stocks, ETFs, or bonds, chances are you've used a brokerage. Companies like Public Investing, Inc. and Delmore Group provide platforms that let you manage your investments. But here's the key takeaway: brokerage accounts are self-directed. That means you call the shots, from selecting what to invest in to deciding when to sell. While this offers flexibility, it also means you're responsible for understanding the risks. Look for brokers that are members of FINRA and SIPC. This ensures your securities are protected up to $500,000 in case of broker failure. For added peace of mind, always read the fine print about account features, especially if you're exploring alternative assets or cryptocurrencies. 2. High-yield cash accounts: a safe bet. High-yield cash accounts are gaining popularity, and for good reason. They offer interest rates significantly higher than traditional savings accounts. Here's how they work. Funds in these accounts are typically deposited into partner banks, where they earn interest, the added bonus. They're eligible for FDIC insurance, giving you protection up to $250,000 per bank. However, keep in mind that these accounts are not banks themselves. For instance, Public Investing offers such accounts, but your money is automatically moved to partner banks for interest accrual. 3. ETFs and treasury bills: balancing risk and reward. ETFs, or exchange-traded funds, are fantastic for beginners and seasoned investors alike. They pool together investments, giving you exposure to a diverse range of assets without having to buy each one individually. Before investing, always read the ETF's prospectus. This document outlines its objectives, strategies, risks, and costs. It's like the instruction manual for your investment. Treasury bills, on the other hand, are short-term government bonds. They're considered one of the safest investments because they're backed by the U.S. government. While they're not FDIC insured, they carry very low risk. 4. The truth about cryptocurrency and alternative assets. Cryptocurrencies like Bitcoin have become a hot topic, especially with Bitcoin recently nearing $100,000. But here's the reality: crypto is highly speculative and comes with a high degree of risk. Unlike stocks or bonds, cryptocurrencies are not protected by FDIC or SIPC insurance. This means if the platform you're using goes under, you could lose everything. Similarly, alternative assets like ETFs or fractional ownership in real estate can diversify your portfolio but require thorough research. Platforms like Delmore Group offer such services, but make sure they're FINRA registered for added security. 5. Understanding performance data and risk disclosure. When it comes to investment performance data, there's one golden rule: past performance is no guarantee of future results. Always remember that the value of your investments will fluctuate, and there's no such thing as a risk-free investment. To make informed decisions, read the prospectus for any asset you're considering. Pay attention to expense ratios and fees they eat into your returns. Look for long-term trends rather than short-term spikes. Investing isn't about avoiding risks, it's about managing them wisely. By understanding your options, from high-yield cash accounts to ETFs, cryptocurrencies, and beyond, you're setting yourself up for long-term success. If you found this video helpful, give it a thumbs up. Subscribe to The Money Philosopher and hit the notification bell so you never miss an update. Remember, financial freedom is a journey, and we're here to walk it with you.